Hi, I'm Michael Lund. For the next few minutes, I'd like to talk about the solutions to a problem that I run into quite a bit, which is this. Someone is dealing with a house, can't afford to continue making mortgage payments or to keep the utilities on, but at the same time, this person does not want to sell to a private or institutional investor who will give them a very deeply discounted offer for their home. And this seller is looking at potentially losing a large part of their equity. So in the course of this video, we'll talk about some things that you might be able to do for yourself if you're in this situation, where you don't need to reach out to someone like me. You're, of course, welcome to talk to me about anything on this video. And there may be some things where we decide, yes, it would actually be very useful for us to talk about doing business together. So let's just talk about these situations, okay? So suppose the number of situations is large, right? It could be someone has a forced move. They've already moved. They're making two payments on houses, and they can't continue doing that. They might be up against a deadline for a foreclosure, okay? And so they need to get this loan reinstated quickly. They have a lot of equity in the home. If the house forecloses, they could stand to lose a large part of that. It could be that you or someone you love is faced with going into assisted living right away. You need equity in the home so that you can help pay for this experience. But at the same time, you've got to pay for something now, and you can't afford to do that and continue making the house payment. So you're kind of caught in a bind. There are many situations like this, okay? So I hope when we're done with this that you feel like there's some ideas, okay? First of all, if you can keep the house, there might be some ways that you can do that. Lenders call these retention options. One retention option is called forbearance, where for a period of time, a person may not be making their mortgage payments, and the lender agrees to let them alone for that period of time. It doesn't mean that the payments aren't going to be due. At the end of the forbearance period, usually they are due in full. This can be 3 months, 6 months, it can be a year. In my opinion, these year forbearances are kind of abusive because people who can't pay a year ago, are they going to be able to catch up everything they couldn't pay at that time and everything in the intervening year? Okay, so I've known people who are forced into foreclosure because of the forbearances. It can be a useful tool in the right circumstances, though, so we can talk about that if you'd like. Another option available to you is a loan modification. This is where arrears on a loan are kind of tacked into another loan or rolled into an existing loan. There's a trial period, and if the borrower succeeds in making payments during this trial period, they can move forward with a modified loan. The new loan is registered at the county, and it's basically a new agreement. Sometimes the payments go up. This is actually true. I've seen them go up significantly. Sometimes they go down. Even when they do go down, almost always the interest goes up. The amount that is paid in interest goes up, and the amount that goes into principal goes down. So even though the net payment increases, it's worth looking at, would it actually be better for you to rent rather than continue to make these payments? I've seen some cases where actually renting in the same neighborhood would be financially better than accepting the terms being offered in a loan modification. That being said, I've known that loan modifications have kept some very, very vulnerable people in their house when otherwise they would be on the street. So it is worth talking about, okay? All right, other options, if you're going to be getting rid of the house, if you're going to be moving on and getting out from under the loan, your options are really you can sell to someone who's going to be living in the house themselves, or you might be selling it to an investor who will plan to make money on it before they sell the house to someone who's going to be living in it themselves. They might also use the home as a rental, okay? For you, what's important to know is that the highest price is usually going to be from someone who's going to be living in the house themselves, because they don't need a discount in order to justify purchasing the house. For them, the benefit is they've got a place to live. Okay. If you're going to be working with an investor, they will typically give you a discounted offer, sometimes a very highly discounted offer. And for you, the benefit for that would be speed and ease. And we're going to show some examples of that in a moment. That may not be what you want, though. You may want to keep more of the equity in the house for yourself because, frankly, you need it. Okay. And there are ways that I think you can find a very happy medium between these, okay, where you can keep most of the equity in your home, but you can also find a way to make those payments. Okay, so let's talk about this. All right, so the worst option that could happen to someone is if unpaid payments go long enough that a lender decides to take matters into their own hands and they foreclose on the property. What that will mean for someone is ultimately there will be an auction, an investor will probably get the property, and the chances of getting any equity are greatly reduced. Sometimes people are told that they will never get their equity back. That is not always true. There is a risk of that. Sometimes at the auction, someone does pay more than what is owed on the property. And in that case, there's what's called an overage. The lender will typically not go out of their way to tell you that this money is out there. It will probably be a lot less than you could get if you were selling the house yourself, but there might be some money out there, okay? However, sometimes people lose everything when the house goes to foreclosure, okay? Something that is not sometimes, something that is always, is there will be damage to somebody's credit. If this individual is no longer alive, that may not be a concern, right? But if someone is planning to make some purchases, this is going to be a problem because it will greatly impact their ability to borrow money of any kind, to get a credit card, to buy a new house, to buy a car for a very long period of time. And it's not just from the date of the auction, it's from the date that the bank actually discharges the property, which could be quite a ways into the future, okay? The other thing about a foreclosure is the borrower loses control over the process. Somebody else runs the show and it's not you, okay? So there are some advantages to taking advantage of what you can do for yourself, okay? So in line with the idea that the best thing you can do to maximize your purchase price is to find a retail buyer, can you borrow money for a short period of time so that you can make payments? Now, this is not a good strategy for a long-term solution, okay? But if you have a lot of equity in your home, could you dip into a HELOC, for example, to make those payments, okay? You will be required to make interest payments on the money you've borrowed, but this might be a way to kind of juggle things so that in the end, you might actually be able to sell the house, okay? If this process goes on for a longer period of time, this will add up, okay? So that is something you have to bear in mind, but it's something that might work. You might be able to get family members to loan money to you, okay? So that's another idea. Bear in mind, you need to be able to make sure that you pay off these people who are close to you, or it could damage your relationship with them. However, I have known people who have done this, and it can be useful, okay? You might be able to sell some assets to make these payments. Can you sell a car? That might be another way that you could deal with this. I have another video where I have other ideas for just avoiding foreclosure in general. But these ideas are specific to if you are intent on selling the house and you just need a temporary solution so that you can make payments, okay? Another option I'll mention here is that there are companies that will advance money to you based on what they expect the house can be sold for. This is available if you have enough equity. They'll advance, for example, 70% of what they think the house is worth. And then when the house is finally sold to a retail buyer, they will subtract their piece of the action out of the rest, and then you'll get what's left over. Okay, so that's something else that is available. Okay. So here is what I think is a very unique solution. And I'm not aware of many institutional or private investors who are offering this, but I think it's fair because if someone has a perfectly good house where it could sell for a large amount of money and someone could clear their debt easily, it can hurt if they sell to an investor and they lose a lot of that money. Okay. This is a way to make sure the investor is protected, and there are reasons why they make these discounted offers, while also allowing the borrower to keep a large part of their equity. Okay. This is what's called a joint venture. This can be used in cases where a house is physically distressed, where it needs a lot of fixing up in order to be ready to be sold. It can also be used in cases where a house is ready to be moved into, but it's just going to be stressful to make payments until a buyer can be found. Okay. So this joint venture is an agreement that protects both parties. Okay. There's someone who basically agrees to purchase the house with the intent of reselling it. So this part is like a standard investor. But what's different is that there's an agreement between the parties that when it is finally resold, that the amount that this individual is retaining for themselves is tightly controlled. And hopefully the vast majority of the money will go to the person, the original homeowner. Okay. When the house is finally sold, the person who bought it in the interim is reimbursed for their holding costs. And then based on some prearranged agreement that everyone has agreed to up front, they divide the money that comes in when the house is sold between themselves. And as we'll see in a moment, this can be significantly greater than the alternatives. Okay. So as I say here, the main goal is to allow you, the original homeowner, to keep more money for yourself, while also letting someone else relieve you of some financial pressures. Okay, so it takes a load off of your mind while also helping you to get more money. Okay, so the least expensive way to do this is with what is called seller financing. And the way that I recommend doing this, in fact, I think it's the only way to do this, is what's called a wraparound mortgage. That's where the existing mortgage is kept in place, and the new owner legally obligates himself or herself to make payments to the original owner. This is a protection to the original owner to make sure that those payments continue to be made. Those payments will be less than would be possible if an investor loan were to be acquired. And it means that in the end, both the original homeowner and the buyer will receive more money because less money will have been spent. Okay. Another benefit of this is if the original homeowner has been behind on their payments, especially if there's something to be reinstated, the loan gets reinstated, and there's a period of time where payments are made on time. This rehabilitates somebody's credit. It rebuilds their credit. And it makes it easier for them to get back up and qualify for their next purchase. Okay, that is not the case in a traditional investor situation where they were behind, someone swooped in, bought the house, and so the last note on when they were making payments was that they were behind. There was a sour note. At least they didn't go to foreclosure. But if they can actually be reinstated and make on-time payments for a period of time, that looks really good. Okay. Sometimes it is necessary to use an investor loan or some other thing, or it's quite frankly, someone can pay for this in cash, but it doesn't have the same ability to rebuild somebody's credit. Okay. All right, so let's go through some mathematical illustrations of what this would look like. These are not like a contractual guarantee. This is just to explain in numbers so someone can understand what this actually looks like. They're highly simplified examples, but it helps someone understand what are the benefits to somebody's equity of doing this. So the first example I've got here is, suppose you're selling the house traditionally. Let's say we want to start marketing the house at $500,000. The initial mortgage balance is $300,000. Okay, so there's a $200,000 spread there. Right now, at the end of 2025, going into 2026, we're in the middle of what is called a buyer's market, which means that there's a lot of homes on the market. There aren't a lot of buyers to go around. And so buyers have a lot of say. They have a lot of room to choose the house that they want. So that means that homes are sitting on the market longer and their prices are going down. Okay. This can be stressful if you're worried about the number of payments you have to make. So let's say the monthly payments are $2,500. Okay, for 6 months, that would be 6 times $2,500 or $15,000. Okay. Utility and other payments over 6 months, let's pretend it's $500 a month. Let's say it's $3,000 for 6 months. Let's also say that in the course of selling the house, there's some repairs that need to be made, and they're moderate repairs. They're about $6,000. Okay. Repairs to a home can be much more than this. They can be much less. Let's just say for this example that it's $6,000. Finally, after 6 months, the house sells for $475,000. Real estate commission and closing costs for this home is usually about 8%. That's what I'm using as an example here. That would be about $38,000. In that 6 months, suppose that the mortgage has been paid down. It's no longer $300,000. It's been paid down by $2,000. And so if you subtract from $475,000 all of these payments, you will see that $115,000 net is going to the homeowner. Okay. So $115,000 is money that could be very useful for the next stage of someone's life, right? You may not want to lose all of that money. Okay, let's look at another example. This is if you are selling the home to an investor. So again, selling to an investor is done for the sake of speed and ease. Okay. Again, the mortgage balance is $300,000. The investor comes up to the homeowner and says, I will pay you $310,000. The homeowner does not have to worry about 6 months of payments, utilities, the repairs of the home, doesn't have to worry about what the home eventually sells for, or the real estate commission and other closing costs. That's all on the investor. Okay. So as you can see in this example, there is now $10,000 going to the homeowner. Okay. A lot of headaches have been saved, but there's a lot of equity that's been lost. The reason I use this example is because I know this really happens. I was talking to a family once where they were on the verge of foreclosure, not because of some payments that they were not making. It was because of a legal nit that the lender was exploiting from 5 years earlier. This individual had changed jobs the day before closing on their mortgage and had failed to disclose that to the lender. This was a small lender that was looking for an excuse to increase their liquidity. And so they were foreclosing on these people who weren't even behind. One of the family members had cancer and they had some dire financial situations because of that. So I was circling this around to some investors, and one of them asked me what they owed on the property, and I told them what was owed. And this person literally offered $10,000 more than that in order to avoid this going into foreclosure. The house was basically new. Okay, this was almost a new construction build. It had gone up in value quite a bit, and so there wasn't a huge amount of equity, but there was really a better way for this family. Okay, so let's talk about what could be a better way. Okay, notice in this example, the homeowner is getting $10,000. Now let's talk about the example where there's a joint venture. Okay, start marketing the property at $500,000. There's an initial mortgage balance of $300,000. Let's pretend everything else is the same as in the first example. Okay, 6 months of payments. There's $2,500 a month. There will be $15,000 to be paid, but that's not the homeowner. That's the new buyer. Okay. Utility and other payments over 6 months, still $3,000 paid by the new owner. Repairs to the home, $6,000. The home eventually sells for $475,000. Here are some things that are different, okay? The real estate commissions and closing costs, we're going to pay for the buyer's agent commission for the person who's buying the house. We're not going to be paying for the seller commission, okay? Because in this case, the new buyer has the ability to market the house himself, okay? There will be some additional legal fees paid by the new owner because we have to make the legal agreement. The new mortgage balance is still $298,000. There will be equity sharing with the new owner in the amount of $32,000. This is negotiable, but this is done for the sake of the things that are being saved in commission, as well as the risk that this new buyer is taking on for the 6 months and making all these additional payments, okay? This is generally framed as a percentage of the net proceeds. So it's designed to be such that if the original homeowner makes more money, then the new owner, the new buyer, will also make more money. Their fortunes are intertwined. And if either one of them makes less money, the other one makes less money. So they both have the goal of making as much money as they can for themselves, okay? And all of this will be spelled out in the agreement that they have with each other. This is not a loan where if it goes on longer, then the person who's paying this money is accruing more interest over time. And so there's kind of a vested interest for it to go on longer, okay? The goal is to get this done, to sell as much money and to do it as conveniently and as easily as possible. So in this example, there's $94,000 to the original homeowner, okay? So that is less than $115,000, okay? But it's a far cry from the $10,000, okay? So why, a person might ask, why didn't this investor just offer, like in this example, why couldn't this person just have it offered $394,000 up front? Well, the reason for that is because this investor doesn't know what all these crossed out charges will be. There are risks involved that the investor doesn't know yet. It might be that the home will actually sell for only $400,000. It might be that the home is on the market for 1 year. There's some things that investor doesn't know yet. So they build into their offer some allowances for their risk. The beauty of this system is that when it's finally sold to a retail buyer, we know what all the charges are. The likelihood is that there will be enough money to go around when it's all said and done. The new homeowner, the partner who agrees to buy the house, doesn't need $115,000 in equity. Okay, that would be a lot of money to give to them for what they're doing. Most of that money belongs in the hands of the original homeowner. Okay. By the same token, this person, this investor, can't afford to lose their shirt, which is a possibility if they're going to be paying all these fees for a period of time that they don't understand, that they don't know yet, because they don't have a crystal ball for the future. This is just saying, look, we're going to agree at the beginning that we're just going to work together. We're going to both share the risks of this, but we're going to also make sure that most of the benefit goes to the original homeowner when the property eventually sells. That is the objective. That is the goal. Okay. So this is what I hope is a good illustration of how this might work. It might work differently for you, and I want to make sure that you feel good about whatever happens. It's important that whenever you do something like this, that you are both legally protected. Okay, so there has to be legal protection for you as well as for the other partner. But it's also important that you trust the other person. If either of those is not in place, if it's legally shaky, or even if it is a good contract, you don't want to have to sue somebody. You want to be able to trust them. Okay. You really need to have both of those. So I would welcome an opportunity to talk to you and anyone that you trust. If you'd like to talk to your attorney, if you have a real estate agent or a family member that you trust, I'd be happy to answer any questions about this. The reason I'm in this business is because I want to make a living while making a good outcome for everyone. I want this to be something that you feel good about, and that in the future you would be willing to talk to other people about and say, you know what, this really saved my finances. I'm really happy that this happened. And it is my goal that you will be able to tell stories like that. Again, my name is Michael Lund. I am the real estate surgeon, and I look forward to meeting you in person soon. Thank you for watching.